Investing in South Florida vacation homes, is it a smart move? Let's be honest, you've pictured it. Waking up to the sound of waves, knowing your South Florida vacation home isn't just your personal paradise, but a money-making machine. Now, picture this. Your rental income gets devoured by insane insurance premiums, and a sudden dip in tourism turns that dream into a financial nightmare. So, what's the real story? Are we looking at a golden ticket or a financial trap? I've been in the trenches with investors, navigating everything from the sandy shores of Miami Beach to the golf courses of Naples. I've seen the incredible wins and the soul-crushing losses. And the truth is, the headlines you see, whether they're screaming about a boom or an Airbnb bust, they never tell the whole story. The market has changed big time. The casual hosts who jumped in during that post-pandemic travel craze, most of them have been weeded out. What's left is a more professional, more competitive, but also a more sustainable market for people who are serious. But what does that mean for you right now in 2026? In this video, we're going to break it all down. First, we'll explore the golden ticket. All the reasons South Florida is still one of the hottest vacation rental markets on the planet. We'll look at the powerful demand, the real income potential, and the lifestyle perks you just can't get anywhere else. Then we'll stare the financial trap right in the face. This is where we get brutally honest about the risks. We're going to spend a lot of time on the single biggest issue facing every owner today, the property insurance crisis. We'll also tear apart the mountain of other expenses and the market curveballs like tourism shifts and condo oversupply that could sideswipe your investment. Finally, and most importantly, I'm giving you the 2026 playbook. We'll pinpoint which locations and property types are actually working and reveal the specific strategies successful investors are using right now to find great deals and make money in this buyer-friendly market. This isn't about timing the market, it's about understanding it. By the end of this, you'll have a clear, data-driven way to decide if a South Florida vacation home is the right move for your financial goals. So if you're serious about making a smart decision, you're in the right place. Let's get into it. The golden ticket, the enduring allure of South Florida. To get why South Florida works, you have to appreciate the massive, overwhelming force of its demand. This isn't just about nice beaches. It's a multi-layered engine that's constantly pulling people into the state. Let's start with tourism. Florida's visitor numbers have been on a record-breaking streak, and it's a sustained, long-term trend that projections show is continuing to grow. What's driving this? Well, the obvious answer is tourism. Domestic travelers are the backbone of this market, making up over 91.5% of visitors last year. They flock here from November to April to escape the cold, creating a predictable high-demand window where you can charge top-dollar nightly rates. But unlike other spots that turn into ghost towns, South Florida gets a second wind in the summer from families and a huge influx of visitors from Latin America. And getting here, it's ridiculously easy. The region is served by major international hubs. Fort Lauderdale Hollywood International Airport, FLL, handles tens of millions of passengers annually, and Miami International Airport, MIA, is one of the busiest gateways in the entire Western Hemisphere. This easy access opens your property up to a global pool of tourists, a structural advantage most vacation markets can only dream of. Beyond tourism, we're seeing a huge wave of corporate and wealth migration. You've probably heard about billionaire Ken Griffin moving his finance empires, Citadel and Citadel Securities, from Chicago to Miami. He's not just moving his family, he's building a new $2.5 billion global headquarters in Brickell. While construction is now set to start late next year, this move is a massive stamp of approval on the region's future as a world financial hub. And it's not just Citadel, it's a whole trend of companies and wealthy individuals relocating for the friendly tax and business environment. These new residents and the business travel they create add another thick layer of rental demand. Finally, you can't ignore the mega events. South Florida is a magnet for huge events that create insane demand for rentals. Looking ahead, Miami is a host city for the 2026 FIFA World Cup. Hard Rock Stadium will host an incredible 7 matches, including a quarterfinal and the bronze final, featuring teams with massive global followings like Brazil and Portugal. The flood of fans for these games will create an unprecedented surge in demand for short-term rentals, letting savvy investors cash in on sky-high rates. When you combine relentless tourism, corporate migration, and a calendar packed with world-class events, you get a demand engine that's incredibly tough to bet against. Strong rental yields and appreciation potential. Okay, demand is great, but let's talk about what really matters: money. This is where we see if that demand turns into actual dollars in your pocket. While the market is definitely tougher than a few years ago, the data shows the right properties in the right places can still deliver killer returns. Let's talk income. The magic words are average daily rate, ADR, occupancy, and seasonality. South Florida's seasonality is its superpower. You'll make most of your money in the peak winter season, from December to April. During these months, it's common for beachfront properties to pull in ADRs of $300 to $800 a night. In a market like Naples, for instance, the ADR can top $425 in the high season. Let's use a real-world example from market data. Take a well-located beach condo in Naples. For 2026, it's projected to have an annual occupancy of 58%. That might sound low, but it accounts for the extreme seasons, a slammed winter and a much slower summer. With a projected ADR of $385, that property could pull in about $81,471 in annual revenue. Data for the wider Naples area shows a typical property earning around $3,689 a month, while the top performers in prime locations can clear over $10,708 monthly. These aren't fantasy numbers. They're based on the real performance of thousands of listings. The financial trap, the harsh realities of owning in paradise. All right, let's get real. For every happy story of a cash-flowing vacation rental in South Florida, there's a nightmare scenario of an investor ambushed by hidden costs and market risks. This is the financial trap, and ignoring it is the fastest way to kill your dream. The number one mistake investors make is buying based on rosy revenue projections without stress testing them against the harsh realities on the ground. Let's pull back the curtain on the 3 biggest threats to your profit: the insurance crisis, the mountain of operating costs, and the market's unpredictable curveballs. The insurance crisis, the elephant in the room. If one single issue defines the risk of Florida real estate today, it's this: property insurance isn't a minor line item. It's a full-blown crisis that can single-handedly destroy your cash flow. We've seen premiums for some properties jump 200 to 300%, and this problem is not going away. So what's happening? It's a perfect storm. First, the obvious: hurricanes. Florida is a geographic target, and after several devastating storms, the global companies that insure the insurance companies have jacked up their rates or just left the state entirely. Second, the state has been drowning in lawsuits and fraud, which drove costs through the roof for insurers, and they've passed that cost on to you. The result is a chaotic market. For you, the investor, it means you can get wildly different insurance quotes for the exact same property. You might model a deal thinking the premium will be $4,000, only to get quotes for $7,000, $17,000, or even more. This volatility makes it almost impossible to budget your net income. An unexpected $10,000 jump in your insurance bill can vaporize your entire year's profit. The property itself is a huge factor. Location is everything. A home on the water will have a much higher premium than one a few miles inland. The age and construction of the home are also critical. Homes built after the state toughened up building codes, especially those with newer roofs and impact windows, are way easier to insure and get better rates. There's a reason you hear resilience is priced in. Hurricane proofing isn't a bonus anymore. It's essential for financial survival. For condo investors, it's even trickier. After the tragic Surfside collapse, new state laws require condo associations to fully fund their repair reserves and conduct regular safety inspections. While these laws are vital for safety, they're causing massive special assessments and huge hikes in monthly HOA fees as buildings scramble to get the money. So even if your personal unit insurance is okay, your share of the building's master policy and soaring HOA fees can still crush your numbers. It's also gotten much harder to get a loan for units in older buildings that aren't following these new reserve rules. As an investor in 2026, you can't just get a ballpark insurance quote. You must get multiple binding quotes before you're under contract. You need to be obsessed with the age of the roof, the type of windows, and the property's elevation. For a condo, you have to do a forensic audit of the association's finances, its reserve study, and its own insurance. The insurance crisis is the #1 financial trap. Underestimating it is a mistake you can't afford to make. Period. The mountain of operating expenses, insurance is the big boss, but there's a whole army of other costs waiting to ambush your profits. First-time investors get seduced by that big, exciting gross revenue number, that $81,000 a year we talked about. But gross revenue is vanity. Net cash flow is sanity. And the road from gross to net is paved with a mountain of expenses. Let's break down the gotchas. 1. Property management fees. Unless you live down the street and want a second job, you need a property manager. They handle marketing, booking, guest communication, cleaning, maintenance, everything. For that, they charge between 20% and 30% of your gross rental revenue. On an $81,000 a year property, that's $16,000 to $24,000 right off the top. It's a huge cost, but for an out-of-state investor, it's pretty much unavoidable. 2. Property taxes. Florida's famous no state income tax is great, but they make up for it with property taxes. These are set locally and are based on your home's assessed value. They can be a serious chunk of change, often 1.5% to 2% of the property's value each year. On a $500,000 vacation home, that could be a $7,500 to $10,000 annual tax bill. You have to check the specific tax rates for the exact city and county. 3. HOA/condo fees. As we discussed, these are a major and rising expense, especially for condos. Post-Surfside laws are forcing associations to build their reserves, meaning higher monthly fees and the constant threat of huge special assessments for big-ticket repairs like a new roof or structural work. These fees can run from a few hundred to over $1,000 a month. You must plan for them to go up. 4. Utilities and maintenance. As a short-term rental owner, you foot the bill for everything: electricity, water, cable, and high-speed internet, which is absolutely non-negotiable. Florida is hot, so the AC runs constantly, leading to monster electricity bills in the summer. You also have to budget for landscaping, pool service, pest control, and all the things that will inevitably break. A good rule of thumb is to set aside 1 to 2% of the property's value every year just for maintenance. That's another $5,000 to $10,000 on a $500,000 home. 5. Furnishings and supplies. Your rental needs to be fully and nicely furnished. That's a big upfront cost, anywhere from $20,000 to $50,000 or more. And it's not a one-time thing. Furniture gets worn out, appliances die, and you're constantly replacing linens. You also have to keep it stocked with soap, shampoo, paper towels, coffee, all the little things guests expect. When you add it all up, insurance, management, taxes, HOA fees, utilities, and maintenance. These costs can easily eat up 50 to 70% of your gross rental income. That exciting $81,000 in revenue can quickly shrink to just $24,000 in operating income, and that's before you've paid your mortgage. Underestimating these costs is the second fastest way to fail. Market risks and headwinds. The final piece of the financial trap is the stuff that's completely out of your control. Even though the long-term demand for South Florida is solid, the short-term rental market isn't immune to economic curveballs and regulatory headaches. First, let's talk about a tourism dip. While overall Florida visitor numbers are growing, the type of travel can change. For example, recent data from late 2025 showed a surprising drop in Canadian visitors, who are a huge part of South Florida's winter season. While other international markets are growing, it shows how dependent you are on specific groups of travelers who can be affected by currency exchange rates or recessions in their home countries. A broader economic downturn could also cause families to cut back on vacations, forcing you to lower your prices to get heads in beds. Second is the risk of oversupply. The Airbnb boom of the last few years created a flood of new rental listings. In some specific areas, especially with luxury condos, there's a real concern that supply is starting to outrun demand. One real estate expert, Peter Zalewski, is so pessimistic, he believes a condo market crash is coming in 2026 as owners get slammed with high fees and are forced to sell. While not everyone agrees, it's obvious there's a ton of competition. To win in a crowded market, your property has to be special. Just having a place isn't enough anymore. Finally, there's the ever-present regulatory risk. While Florida state law is generally friendly to short-term rentals, it lets local cities and counties create their own rules. This has created a messy and confusing patchwork of regulations that change from one town to the next. For example, Miami Beach has some of the toughest rules in the nation, banning rentals under 6 months in many areas. Other cities make you get business licenses, pass inspections, and display permit numbers. These rules are always changing. Assuming the regulations are the same everywhere is a rookie mistake that can get you shut down. These three things, the economic cycle, the risk of oversupply, and the shifting rules, create a level of uncertainty you have to accept. Ignoring them and just hoping the good times will last forever is like walking blindfolded into a trap. The financial trap. The harsh realities of owning in paradise. All right, let's get real. For every happy story of a cash-flowing vacation rental in South Florida, there's a nightmare scenario of an investor ambushed by hidden costs and market risks. This is the financial trap, and ignoring it is the fastest way to kill your dream. The number one mistake investors make is buying based on rosy revenue projections without stress testing them against the harsh realities on the ground. Let's pull back the curtain on the three biggest threats to your profit: the insurance crisis, the mountain of operating costs, and the market's unpredictable curveballs. The insurance crisis, the elephant in the room. If one single issue defines the risk of Florida real estate today, it's this. Property insurance isn't a minor line item. It's a full-blown crisis that can single-handedly destroy your cash flow. We've seen premiums for some properties jump 200 to 300%, and this problem is not going away. So what's happening? It's a perfect storm. First, the obvious hurricanes. Florida is a geographic target, and after several devastating storms, the global companies that insure the insurance companies have jacked up their rates or just left the state entirely. Second, the state has been drowning in lawsuits and fraud, which drove costs through the roof for insurers, and they've passed that cost on to you. The result is a chaotic market. For you, the investor, it means you can get wildly different insurance quotes for the exact same property. You might model a deal thinking the premium will be $4,000, only to get quotes for $7,000, $17,000, or even more. This volatility makes it almost impossible to budget your net income. An unexpected $10,000 jump in your insurance bill can vaporize your entire year's profit. The property itself is a huge factor. Location is everything. A home on the water will have a much higher premium than one a few miles inland. The age and construction of the home are also critical. Homes built after the state toughened up building codes, especially those with newer roofs and impact windows, are way easier to insure and get better rates. There's a reason you hear resilience is priced in. Hurricane proofing isn't a bonus anymore. It's essential for financial survival. For condo investors, it's even trickier. After the tragic Surfside collapse, new state laws require condo associations to fully fund their repair reserves and conduct regular safety inspections. While these laws are vital for safety, they're causing massive special assessments and huge hikes in monthly HOA fees as buildings scramble to get the money. So even if your personal unit insurance is okay, your share of the building's master policy and soaring HOA fees can still crush your numbers. It's also gotten much harder to get a loan for units in older buildings that aren't following these new reserve rules. The verdict. Who is this investment actually for? So after all of this, what's the verdict? Is investing in a South Florida vacation home in 2026 a smart move? The answer is clear. It depends entirely on who you are as an investor. This investment is not for the get-rich-quick chaser. It is not for the person looking for a passive, hands-off income stream. It is absolutely not for the buyer who is stretched thin and has no cash reserves to weather a storm, both literally and figuratively. If you're hypnotized by the gross revenue numbers but haven't stress-tested your deal against a $15,000 insurance bill or a 30% vacancy rate in August, this market will find you, and it will hurt. This investment is for the savvy, diligent, and well-capitalized investor who treats it like a business. It's for the investor with a long-term vision who knows that real estate moves in cycles. It's for the investor who's willing to do the boring upfront homework on insurance, city regulations, and HOA documents. It's for the investor who has a solid down payment and enough cash on the side to handle a surprise assessment or a new AC unit. It's for the value-add specialist who can spot a tired property and knows how to turn it into a gem. And it's for the person or family who truly values the lifestyle dividend and wants an asset they can both profit from and personally enjoy. The party for easy money in the South Florida vacation rental market is over. What's left is an opportunity for serious investors to build real wealth and own a legacy asset in one of the world's most exciting places. It is a golden ticket, but only if you have the right map and are prepared for the journey. We've covered a ton of ground, from the powerful forces driving demand to the critical financial traps you have to avoid. We've laid out the playbook for success in 2026. Focusing on location, property type, and smart negotiating. The South Florida market is complex, but it's not a mystery. With the right info and a clear strategy, you can make a great decision that fits your life and your goals. If you're serious about taking the next step and want to look at specific opportunities, I'm here to help. All of my contact info, including a link to schedule a one-on-one consultation, is in the description below. We can dive into your goals and find properties that might be the right fit for you. Thanks for investing your time with me today. If this analysis was helpful, hit that like button and subscribe for more real talk about the real estate market. I'll see you in the next video.